Good morning and a very warm welcome to each and every one of you. Thank you so much for joining us today. It's 8:30 and let's get going. I'm Neil Brown, the head of Anchor Asset Management, and it's my absolute pleasure to be your host this morning. The structure of today is going to be about 45 to 50 minutes of presentations, followed by about 10 to 15 minutes of questions. We will end on time. Please pop your questions in the Q&A tab at the bottom of your screen. Please don't use the chat function, please use the Q&A tab. And please do so throughout the entire session. We'll pick them up at the end and deal with them. Our presenters today are Nolan Wapenaar and Delport. Nolan is the Co-CIO of Anchor Asset Management and is responsible for all things fixed income at Anchor. Casey is a member of his team and he'll introduce her to you later. Nolan has been in the markets for about 23 years and joined Anchor in 2015. He's previously held senior positions at Rand Merchant Bank and Deutsche Bank, and gained experience in New York, London, and in South Africa. We have been through a really bizarre, tough, and tumultuous 2 and a bit years, and the world continues to be in turmoil with many financial and other issues. Unprecedented debt levels following COVID-induced stimulus, very high inflation rates, and the resultant increases in interest rates around the world are just the start. Recession fears, bear markets, wild share price movements, the war in Ukraine, supply disruptions, and the latest COVID waves resulting in lockdowns in China. But in England, they celebrate the Queen's Jubilee, or rather Her Majesty Mumsy, as Charles referred to her, without many sort of masks in sight. So it's a really crazy situation at this point in time out there. And that's just globally. Locally, we have these issues, plus a host of our own local ones, which I'm not going to list as I don't want to depress you or make anybody panic. There's always a lot to be worried about, but there's usually opportunity within the chaos, as we all know. Nolan and Casey are going to make sense of all of this for us today and explain why we believe that given the current circumstances, now is a good time to invest into the most regal of all asset classes, bonds. Nolan, over to you.
Thank you very much, Neil. I appreciate the introduction. And everybody, it is really wonderful to be presenting to you today. So thank you very much for dialing in and for giving us a chance to chat. I'm going to speak for the next 15 minutes and just sort of paint a picture as to the global backdrop, because the global macro environment is really what's dominated financial markets this year. I'm going to hand over to Casey, who is going to chat for about 15 minutes on domestic developments and the silver lining domestically. And then finally, I'm going to sort of sum it all up by looking at what that means for the opportunities in markets. In terms of talking about the global environment, I'm starting with a slide that shows a shop that's closed down. And really what that's trying to denote and talk to is the fact that we are seeing a significant economic slowdown taking place globally. And in fact, I'm talking about, or I'm using a slide here that I used back in January in a presentation you'll find on our web actually, where I said that economic growth last year was quite significant in the US, for example, on the left-hand side, the blue bar. The economy was growing at 6% last year. Next year, the economy is probably going to grow at about 2%, and I see those forecasts have just been slashed. And across the board, you're going to see this massive deceleration of growth that's going to take place in 2022, and that this deceleration of growth is really what's going to drive financial markets. Back in January, everyone laughed at me because we're still talking inflation, and suddenly I think this has become a bit more real. So I'm going to unpack this. But the way I'm going to unpack this is by looking at history. And really what I think we've been through since 2020 is what I'd almost call an age of denialism. So we've denied economic reality. And it's quite interesting. I guess with hindsight, you always got 2020 hindsight. I can go and look at, what my economics lecturer said all those many years ago. And there's an area of truth in what we've learned. So, back in 2020, we went through the COVID lockdowns, which was an unprecedented time, and there was mass stimulus. I think the US led the pack in terms of stimulus. I mean, they were putting checks in the mail to people just to sort of fill up their bank accounts. And there was this denial that printing money would actually result in inflation. Turns out that inflation did actually start to come through. And what we've got here is a chart which shows US headline inflation over time. You can kind of see how headline inflation kept creeping up. So initially we denied there'd be inflation, and then somewhere around beginning of last year, inflation started to pick up, and we still denied it. We denied it by saying inflation is transitory, it's going to spike, it's going to go down, don't need to do anything. And as inflation marched higher, it was about September last year that the markets realized, whoops, inflation isn't transitory, we do need to react. So we couldn't deny inflation anymore. So what happened in September last year, if you look at this chart, which shows interest rate expectations in the US, you can see how interest rates were kind of floored at close to zero. And suddenly the market realized we need to hike rates. It's going to be quite an extreme hiking cycle. And interest rate expectations shot through the roof, up to about 3% on this chart. It's probably about 3.2 right now. And this really was a reaction to low inflation. So again, markets sort of were, and economists were then denying the reality. So, the narrative shifted from, inflation is transitory to we're going to hike rates, but we're going to deny that that's going to have an impact on the economy. So the economy is strong. We're going to hike rates to levels we haven't seen in years, but the economy is not going to slow down. And that became the narrative from September last year, where, the rate hikes were going to sort of slow down inflation without slowing down the economy. Over time, that's exactly what, what the market priced in. So what we've got here is a chart of economic expectations from economists. And you can see that, the economists were expecting the US economy to grow 2.5%, give or take, next year, and notwithstanding rate hikes. And then suddenly in about late Feb, early March this year, the penny dropped to say, wait a minute, rate hikes are really going to slow the economy. And what you've seen is since then almost a sort of frenzy of economists cutting their economic growth expectations, the more daring economists getting out there, projecting recessions, all kinds of exciting things. And that's the realization that the economy is going to slow down. So that's kind of the sort of walkthrough as to where we're at right now, and we're kind of in that paradigm. But what I want to do is just take a step back and say, what are we really saying here? And it sort of does tie back again to, what my lecturer said to me those many years ago, which is, if you print a lot of money, it's going to cause inflation. As a result, you're going to need to hike interest rates. That's going to slow down your economy. And, that's kind of what we've seen. It's what we've lived through. Thing is, if you extrapolate that further, what was the next thing that my economist lecturer said to me? And that was that what you're going to see is inflation for a while is now going to plateau. So we would expect that inflation will now start to track sideways. We would expect that it'll track sideways for a couple of months. And then at some point, as the economy slows down, some economies are going to be pushed into recessions. It's a little bit difficult to debate who. What you're now going to see is that you're going to see signs of inflation coming down. So where are we at? We are definitely seeing inflation track sideways. If I look at US headline inflation, it's stopped going up. It's not going up anymore. It's tracking sideways at about 8% per annum, which is ridiculously high. And we are seeing increasing anecdotal evidence of inflation sort of coming under control. What do I mean? I mean that if we look at US wage growth last year, it's last couple of months of last year, it was averaging about 6% per annum. If you annualize it, right now, if you take the last three sort of wage measurements in the US and you annualize it, the wage growth has slowed to 4.5%. So it's no longer going up. It's still too high, but the point is it's no longer going up. If we look at shipping costs, there was an article on Bloomberg a couple of days ago looking at shipping costs, and the shipping cost index has actually started to turn. And you can actually see shipping costs are beginning to normalize as ships are more able to move around the world. Similarly, actually, the index of fertilizer costs in the US has been coming down. And if you look at commodity prices, you don't need commodity prices to necessarily come down. But, inflation is a measure of how much commodity prices have increased. So even if they plateau and go sideways, the increase slows down to zero, and that in itself becomes deflationary as well. So all of these factors are beginning to play out within the inflation metric, and there's a lot of change sort of underlying the index. Index probably broadly sideways for the next while, but a number of the factors that have been driving inflation up are beginning to abate. So what does that mean, for us? So it means that we're going to be in a world where, financial markets kind of go sideways for a bit. And what we really are looking for is the first signs that inflation is actually coming down. When do we get that? Well, if we look at base effects, when is it going to be more evident that inflation is starting to come down? Probably towards the end of this year, we'll start seeing the first signs of it. And then towards mid-year next year, I think it'll probably become undeniable, if for no reason other than the worst is past us, and base effects will pull it all down. What does that mean for financial markets? What does that mean for bonds? Well, the tide for fixed income investments, and in fact, probably global financial assets, has been quite strongly negative of late. And, that has been based on interest rates going higher. There is a limit to how high interest rates can go. And what we're seeing, and we're seeing it again today, is that as soon as US interest rates, long bonds push to about 3%, I'm thinking the US 10-year bond, what you start to see is the market becomes increasingly unsettled, and it starts to realize that rates much above this are very detrimental to the US economy. So it's almost a natural ceiling that markets are pricing in, which says that rates can't really go much above this because you're going to push yourself into too deep a recession. And we're constantly seeing interest rates actually sort of bouncing around, long bond rates bouncing up to 3%, and then, the market becoming very nervous about the economic consequences and, pricing in slower and slower economic growth. What does that mean for bonds? It means that bonds are probably in the right zip code of where they need to be in terms of yields. And that means that the market environment that's been very negative for fixed income instruments is probably turning about neutral right now. If anything, there's probably a slight tailwind, but by and large, it's neutral as we move into this sort of more stable inflation sort of segment of the economic cycle. So from that perspective, as we move through this cycle, we think that financial conditions become probably a little bit more supportive now, probably more supportive for bonds initially. And then, as we wait for signs of real inflation coming down, we would expect that the market actually becomes quite supportive, and it almost sort of launches the next bull market for fixed income and for equities towards the end of the year. So that's how we're seeing the macro environment as things change. I think what we're really saying is the worst is behind us. The review mirror has been difficult, but looking forward, we're kind of at the pricing point now where the opportunities start to look a lot stronger. So with that, I'm going to hand over to Casey for a while. So Casey is our economist here at Anchor Capital, part of the fixed income team, acts as a fixed income analyst. And, her speciality is understanding South Africa and the dynamics going on within the South African context. Casey, over to you.
Thank you, Nolan, and good morning, everybody. So yes, if we consider the general economic environment in South Africa, over the last 10 years or so, it's often been difficult not to be pessimistic about South Africa's economic prospects, particularly if we consider the various structural constraints that impact us on a daily basis. Unemployment and poverty are likely to remain frustratingly high. Petrol prices are at uncomfortable levels. Food prices are increasing. Consumers across the income spectrum are really starting to feel the pinch. And then we have the chief aggravation of all, load shedding continues unabated. So under these circumstances, it is difficult to see a more positive, longer-term perspective when most average South Africans are focused on just getting through the day or the month. But amongst all of this negative noise, as Nolan alluded to at the beginning of the presentation, there really are actually some really positive economic signs that, for South Africa, our prospects are beginning to turn more positive. We are indeed beginning to heal. And it's these positive economic developments that I want to talk to you about today. Nolan, if you could please change to the next slide. So what I want to do is really start off with what has been the sort of leading positive development of late. And that is that our trade balance has actually been in positive territory for some time, since around the beginning of 2020 to the end of 2019. And this essentially means that as a country, South Africa is selling more goods than they are purchasing, i.e. our exports are outstripping our imports. And this is really being driven by the higher, commodity windfalls that we've seen of late, really sort of boosting our export earnings. And this is an important factor at the end of the day, because that means we are, as a nation, earning some really, really valuable revenues, which at the end of the day boost our fiscal situation. And if we consider the current account specifically and look at the latest numbers, and those numbers actually came in yesterday, SARB reported that the current account surplus widened slightly to 2.2% of GDP in the first quarter of this year, and that was from an upwardly revised 2.1% in the fourth quarter of last year. A slightly stronger merchandise trade surplus, again, due to these good terms of trade that I just mentioned, was offset by a slight widening of the deficit in invisible flows. So looking ahead, we believe that multiple headwinds, such as the effects of the KZN floods, ongoing logistical problems with South Africa's ports and freight rail, slowing global economic growth, and deteriorating terms of trade will weigh on the current account balance, though we still expect the current account to stay in surplus until the fourth quarter of next year. So really, this means that the trade surplus is here to stay for a while yet, and thus, will continue to further boost our revenue earnings and our fiscus overall. And if we move on to the next sort of positive development, the next slide, please, Nolan. And that is really one slide back. That is really that our debt situation is becoming far more positive, and our overall debt trajectory is coming in, less than was initially expected. If you look at the graph in front of you, it indicates various forecasts at different periods, from the medium-term budget speech in 2020 through to the medium-term budget speech in 2021, and then, of course, the latest projections coming from our budget speech of this year. And if we look back to the medium-term budget speech in 2020, at that point, the National Treasury was actually forecasting our debt to GDP to reach around 90.4% in 2024 or 2025, which is, of course, a very uncomfortable number to consider. But if we look at our current situation, our forecasts have come down markedly, and we're now looking at a debt to GDP ratio of around 75.1% instead in 2024, 2025. So really what we're seeing is that, our overall debt trajectory coming down to far more sort of sustainable and comfortable points. I mean, there are, of course, many sort of idiosyncratic factors that one would have to take into consider with these forecasts. It's not set in stone. I mean, for instance, we have seen the extension of the fuel relief levy, which of course puts pressure on government spending and the fiscus in turn. Initially, the extension of the levy was funded by the sale of strategic oil reserves, but this time we expect the fiscus will take a hit, as the latest extension of these measures will result in an estimated 4.5 billion rand in lost tax revenue for the government. So, for instance, you can see these are the type of risk factors that one needs to take into consideration. But overall, the real key message here is that, we went from one point of a very uncomfortable debt situation to far more comfortable and sustainable path going ahead. Nolan, if you can move to the next slide, please. And stemming from this is what we're seeing, our overall policy is really moving towards the right direction as well. If we consider, first of all, there have been some really important changes to the political rhetoric of late. We've seen a number of high-profile arrests. Furthermore, a lot of the members within government and the ANC particularly those involved in various corruption cases or the members of the more sort of rapid economic transformation bloc have largely either been sidelined within the ruling party or have been forcibly stepped aside. And sort of driving this tone as well, we've seen a change in the tone from policy within the ANC. If you look at various communications and policies that are coming through, used to always be more of the typical socialist stance within the ANC. And now in comparison, we're seeing a far more pro-business stance, which is really, really, bodes well for this sort of level of policy expected in the future. And if we consider some of the more key economic policy reforms, really, the key reforms, I think, so far have really been in the electricity sector reforms of last year, as well as the recent spectrum auction and the tourism reforms, in which key milestones were actually reached earlier on this year. The focus is now on key reforms due to start within the transport sector this year. And while some targets seem rather ambitious, these types of reforms typically do take time to transpire. And, as in the electricity sector changes, reforms in the transport sector form part of the targeted increase in private sector participation in areas of the economy previously monopolized by government. And if we consider some of the more specific policy changes, if we start off with the electricity side, which of course has been one of the most key issues of late, we saw the amendments of the Schedule 2 of the Electricity Regulation Act, which essentially has made it possible for private power generators to sell directly to customers. Amended regulations also enable municipalities to self-generate or procure power directly from independent power producers. And we're also seeing, Eskom's unbundling is progressing, with the internal divisionalization concluded in the first quarter of 2020, and the functional separation, so i.e. or transmission, generation, and distribution, was finalized in the first quarter of last year. And overall, the final sort of transmission unbundling is targeted by the end of the second quarter of this year, so towards the end of this month, following of which the National Transmission Company of South Africa will be operational. And this will be followed by the legal separation of the generation and distribution units. So some really, really key reforms in that aspect, which should hopefully drive a more sustainable electricity grid at the end of the day. If we consider the transport sector, the Transnet Freight Rail will allow third-party access to the Freight Rail network by the end of 2022, and this should really improve system capacity. Government has also announced the corporatization of the Transnet National Ports Authority as an independent subsidiary of Transnet, and has since appointed an interim board. And let's really hope that the separation of port infrastructure and operations will create incentives for efficiency and competitiveness between port service providers. Again, a very, very key important policy point on that side. Particularly, we've seen Transnet in the headlines once again for all the wrong reasons. We move over to tourism. We have the new e-visa system, which has been rolled out to select countries in February of this year. So some really key tourism nations such as China, India, Mexico, various of our African neighbors as well, along with Saudi Arabia, Pakistan as well. And these countries can now apply for visas online, which eliminates the need for embassy and consulate visits. We've got some of the more developed nations such as Australia, Canada, the US, the EU as well, which will be added soon. And this should help buoy what has been a sector in the economy at the end of the day that was probably the hardest hit under the height of the COVID pandemic. We consider our water resources, which too has come under pressure given the various levels of droughts throughout the country over the last 2 or 3 years. And we're now seeing legislative drafting and financial modeling that has been done to establish a national water resources infrastructure agency responsible for improving the management of bulk water resources. So hopefully some important traction there as well. If we consider telecommunications, finally, the long-awaited spectrum auction has been conducted, and work is now underway to standardize and improve processes for applications to use property in rolling out towers and fiber to expand our digital communications infrastructure. This work should be finalized by October of this year, which will just help move us more towards the modern digital age. And lastly, if we consider the infrastructure side, We've had a review of the public-private partnership regulations, which was completed in May of 2021, and the recommendations will be implemented from earlier on this year. And this really includes simplifying the regulations, eliminating delays in approval and implementation, standardizing product preparation, and building capacity at all levels of government. So if we consider these various individual policies, if we look at them at a sort of silo individual nature, perhaps they don't feel all that important or all that much. But if we take them as a collective whole, it's really the rhetoric and tone of the policy is moving this country in the right direction to address those structural imbalances that have been present for so long. Again, if we consider them in a collective whole, what they're really aiming to do is to modernize our network industries, to increase competition and small business growth, to prioritize labor-intensive growth, including in agriculture and tourism, and really to promote export competitiveness. And that, at the end of the day, is really where our economy has been lacking. Nolan, if you can move to the next slide, please. So all of these factors that I've been discussing so far, going from the positive trade balance, improving debt trajectory, the various policies I've just outlined, that's really accumulated to what we see now as a ratings recovery from our key international credit rating agencies. So, for example, towards the end of the month, S&P unexpectedly revised the outlook on South Africa's sovereign credit ratings, both our foreign currency and local currency ratings. They've shifted the outlook to positive from stable. We've also seen within April, Moody's and Fitch changing their outlooks from negative to stable. And it really is an important development once again. The key drivers of these positive changes have really been the favorable terms of trade in South Africa that have improved the external and fiscal trajectory, as I just discussed previously. And with regard to other positive drivers, the various agencies have also cited South Africa's reasonably large net external asset position, our flexible currency, and our deep domestic capital markets, which at the end of the day, really provide strong buffers against shifts in external financing. They've also highlighted that there are strong checks and balances in South Africa, which include a constitutionally independent judiciary, which of late we've seen how important that has been, and an independent central bank, and a largely free media. And really, these are important factors to bear in mind when we consider the collective whole of the South African economy. And if we look ahead, in order to receive a full rating upgrade from these agencies, I believe the key agencies will need to see clear evidence of fiscal consolidation from the government side, supported by concrete structural and governance reforms. However, the change in these outlooks alone are an important positive signal that we are heading in a better direction. Overall, it's key to remember how important these credit ratings really are. At the end of the day, they're not just another headline to sort of flip around the media. Many countries rely on foreign investors to purchase their debt, and these investors rely heavily on these credit ratings given by these credit agencies. And a benefits of higher credit ratings include being able to access funds from outside one's country and the ability to attract other forms of financing to a country, such as foreign direct investment, for instance. So obtaining a good sovereign credit rating is usually essential for developing countries that want to access to funding international bond markets, just like South Africa. And if we consider the change in these ratings, the market reacted really positively, not just to the positive outlook change from S&P, but the shift towards more stable outlooks from the likes of Moody's and Fitch. Overall, it has helped to reduce investors' skepticism about the fiscal and growth reform progress so far that we really witnessed. And by large, many investors have actually been unaware of or skeptical about the constructive policy steps so far, following previous growth and or fiscal disappointments. And it's really these constructive policy steps that I wanted to highlight to you today. On that note, Nolan, I'll pass back to you.
Thank you very much, Casey, and hi everybody. Of course, life is a bit challenging here right now. Okay, so I'm battling a bit to turn my computer screen on, which makes life interesting, but I think you can hear me. And there you go. That's the button I'm looking for. Now you can see me, you can hear me, and we can take it forward. So what Casey has essentially said, if we put it all into a nutshell, is that if you look at South Africa 3 years ago and you look at South Africa today, it kind of feels like we're in a better place. We're talking rating upgrades, we're not talking rating downgrades. We are talking policy discussions that are sensible rather than means of shooting ourselves in the foot. We're talking about, a gradual implementation, very gradual, of policies moving in the right direction. And this is slowly sort of gathering momentum, probably too slowly, but it's definitely on the fundamentals more positive than it's been for a while. What I was saying in the beginning of this presentation is that, we're moving through an economic cycle. We're moving through what is almost a traditional economic cycle. And as we move through this economic cycle, certain asset classes are going to behave differently to other asset classes. We are getting to that point in the economic cycle where it becomes a lot more neutral for bonds. It's probably going to be neutral for bonds for a while. We think that bonds probably lead us out of sort of the downturn, and then equities follow later. Very importantly, if we look at the last two economic cycles, as we came out of the downturn, the economy was on a turbocharger from stimulus, and that turbocharger meant that financial market returns were quite strong. This time around, because of the inflation dynamic, the turbocharger is not going to be available, and therefore it's going to be a slower recovery. It's going to be a more gentle recovery, but it's still going to be a upward benefit and a positive investment environment that is going to manifest. And as I was saying, if we look at how the sort of tea leaves lie right now, the best estimates are that we're going to see increasing signs that we're coming through this towards the end of 2022. What does that all mean for fixed income investments? And it really, what matters is what's in the price. So what we've got here is a chart that looks over time at where markets expected interest rates to be at the end on 1 June 2023. So basically a year from now, earlier it was like 18 months from now. And you can see that the market expectation of where South African interest rates will be has gradually drifted upwards. At the moment, the market expects that the repo rate is going to be about 6.5%. And at the bottom, you can actually see where the repo rate is today, and the repo rate is at 4.75%. What does that really mean? It means that the market is pricing in another 1.75% of interest rate hikes between now and this time next year. And that's actually quite an extreme hiking cycle given the dynamics in South Africa of, notwithstanding our recent GDP print, of a slower, of a softer economy, of mass unemployment, etc. So we don't think that the Reserve Bank is likely to hike that far, and it's almost like the market is pricing in a bit of a sort of worst case scenario. As the dynamic turns more positive, we actually think that this creates an opportunity for investors. Put another way, what we've got here is a chart that shows you over time the yield on the government 2030 bond. It used to be a 10-year bond. It's now got about 8 years to maturity, and you can see how the yield has spiked up and down over time. And now, right at the end here, I've kind of drawn a red line across where the yield is today. And what the point we are making is that, notwithstanding the fact that the basic fundamentals in South Africa are improving, notwithstanding the fact that the global economy is gradually sort of getting through the worst of the rate hiking fears, and we're getting to a sort of more positive bond environment, you can actually buy this fixed income instrument and earn more interest income than you could almost at any time over the last 3, 4 years, 5 years. And that just makes this incredibly attractive from that perspective. So what we're saying is bonds are cheap. Bonds are necessarily cheap because we have priced in a lot of pessimism. I see bonds actually getting a little cheaper today here on the dashboard next to me. And at the same time, we think that the environment is gradually shifting to be more neutral, and that the worst is behind us. So from that perspective, how do we conclude? How do we pull this all together? And the example I would use is the South African R186 bond, which really, if we cut through it, is a bond that matures in 4 years' time. So it's a 4-year investment. Today, I can buy that bond and I can earn 8.6% interest income. So I can guarantee myself investment return of 8.6% over the next 4 years. And you're saying, well, over 4 years, the way a bond works is I know that my starting point is my investment today, so I put 100 Rand in. I don't know the sequence of returns. It might be negative 5% followed by positive 13%. What I do know is that over the next 4 years, this bond is going to average a return of 8.6%. And therefore, you buy it today, in 4 years' time, that for 100 Rand in 4 years' time, that investment's worth, it's about 134 Rand is what it grows to over 4 years. What's nice about that is it gives you dead certainty over that period, and we think that the yields that are available are quite compelling. So how do we access those yields? Well, the thing is that bear in mind the bond returns can be a little bit volatile. So what we do is we recommend you look at the Anchor BCI Flexible Income Fund. The rearview mirror as we've moved to this point has been a bit more challenging. But from here on out, what it owns is a third of the portfolio is effectively these bonds going to lock in 8.6% over the next 4 years. And the other 2/3 of the portfolio is essentially cash-like investments that bring stability. And by blending those two, we're able to give the best worlds of a reasonably stable outcome, not a straight line, but at the same time, we're locking in quite an attractive element of those yields. If you're looking for something more stable, the Anchor BCI Core Income Fund, it's not going to surprise you, and it's just going to generate at today's yields 0.5% per month. And it's not subject to the risk of interest rates rising or falling. So we don't carry any market value risk there. 0.5% per month, 6% per annum. And it's a lovely sort of place just to ride out the storm if you're looking to do that while we wait for markets to turn more positive. For investors who are looking at this environment going, you know what, I'm comfortable taking some risk. I know that bonds are going to turn positive again. I know that as we go through the sort of economic cycle, there's a point where current yields just are not sustainable. What you want to do is look at the bond fund. And the bond fund, you're going to earn a yield of circa 9 to 9.5%. But you're locking in sort of long bond exposure. So it's going to be quite a volatile ride. But we know that by the time you get to sort of the turn of the year, that the environment should start to turn significantly more positive as inflation comes down. And in that type of environment, what you're really trying to do is lock in the propensity or possibility for capital gains on bonds. Going to be a bouncy ride to get there, but the destination is sort of with the white knuckle ride over the next year or two. So those are really the fixed income opportunities, and we think that as the market's developing, that accessing some of this 8.6% yield on the 186s makes sense for investors in different guises depending on particular risk appetites. So that's how we're seeing the opportunity set right now. With that, I'm going to end the presentation and thank everybody for sitting through this. And instead, what I'm going to do is switch off sharing and leave my camera on and ask Neil just to sort of read through the questions and hand them over to either Casey or myself. Thank you very much, everybody.
Well done, and thank you so much, Nolan and Casey. You've outdone yourself, and you've ended a good 7 minutes earlier than predicted. So we've got lots of time for questions. We do have a few in the Q&A section. As I mentioned at the beginning, please pop your questions in the Q&A tab, and we'll run through as many of them as possible. I think we've got a decent amount of time, so hopefully we'll get to all of them. Just also, I failed to mention at the start, we will, as usual, send out a link to the presentation, including the slides afterwards. It normally takes a day or so to just clean them up and package it, but that will be distributed afterwards as well. So yeah, please pop your questions in the Q&A and let's dive in. Nolan and Casey, I'm going to sort of try and ask 2 questions at a time, if that's okay. The complicated ones I'll ask one at a time. But yeah, so we can just decide which one of you fields them, and let's dive in. So firstly, Paula and Paul Wood, thank you for your questions. Paula asked, is it a deceleration of growth or growth rates reverting back to pre-COVID-19 rates? After all, 2021 growth rates were from a low base. That's the first question, whether it's just reverting back to where we were before. And then Paul would ask, when you allude to recession, would that mean recede, which actually means contracting? But then you say that it's actually going to slow down. So which is it? Is it contracting, or is it just slowing down?
Should I take that? So let's start with the second question. The global economy is going to slow down, and every country is going to see that differently. And what we expect is most countries' economic growth is going to slow to somewhere around zero. Never going to get it exactly right. So some countries are going to drop below zero. That's the recession. Some might be printing economic growth just above zero for a period, which technically isn't a recession, but it's going to feel that way anyway. So yes, I do use the words interchangeably. What is our base case? Our base case in the USA is that we approach very low growth rates, but not negative growth rates. We just skirt the recession. But there is definitely a significant possibility of us being wrong and getting a recession. Domestically in South Africa, I'll let Casey comment as well. You do have the risk of a recession, but I think that's almost driven by external factors. Floods switching off Transnet, for example, meaning we can't export coal. Eskom, etc., massively hampering mining productivity, which we saw last quarter. So there is, again, a recession, which is a technical term. I think our growth rate of 3% annualized was above expectations. But there is definitely a risk that for these sorts of factors slips below zero. Again, not our base case, but certainly can't be ruled out. We're probably a bit more optimistic that the world sort of skirts close to the cliff without falling off.
The question around whether we're simply reverting to previous growth rates, or
so. Where we're at is that for a period, we need to dip below previous growth rates. And in order to tame inflation, central banks need to slow the economies below where we were previously. So you kind of had too much. You now need to have too little growth for a while before reverting to a new trend. And therefore, in the near term, it's going to be below. In the longer term, we think that trend growth is probably less than trend growth in the previous economic cycle. And that's just a function of our turbocharger from cheap money and stimulus is not going to be there, which it was in the previous cycle.
Great, thank you. And then from someone anonymous. It's a bit more technical question, I guess, around the impact of actually investing in bonds. So if you invest in bonds today, and in 1 year's time, for whatever reason, or potentially equities offer better return prospects, what are the effects and the advantages and consequences or disadvantages of switching out of bonds into equities in a year's time?
So if you invest in bonds today, what you're really looking to do is earn interest income. And if you're in a more stable product, core income fund, for example, it behaves like a big bank account. You sell it, buy equities when the time is right. If you are in a more market-sensitive product like the bond fund, the point in time where equities start to look appealing, bonds are also looking appealing. So what you're probably going to see is a small capital gain on your bonds. And at that point in time, you lock in the capital gain and you move to equities, which is a more, a stronger expression of accessing market risk. So that's the most likely scenario.
Thank you. Then I'm going to combine two questions, one from Jan van Zyl and one from Edward. First one, is the debt situation only saved by commodity windfalls, which in itself is transitory, so cyclical, and given all the very real headwinds, not sustainable? So firstly, is that debt situation only saved by commodity windfalls, and is that not cyclical? And then secondly, how long do we expect the current accounts to remain in surplus? And when can we expect a bond rally given the sharp increases to interest rates expected by the end of 2022?
Casey, do you want to take any of those, or should I go for it?
I think I'll start off with the first one, and then maybe Nolan, you can carry on after that. So with regards to the debt trajectory, I think there's probably two parts to my answer for this one. First of all, yes, in a certain aspect, a lot of our improved revenue windfalls have come from the sort of commodity-driven boost of late, which of course is naturally transitory in nature. However, at this moment, this sort of dynamic is stretching out. It started off last year, but towards the end of last year, we thought this whole revenue commodity boost would work its way through the system. And then, of course, we had the scenario of Russia invading Ukraine, which has simply just exacerbated the situation. So while that continues, yes, we will get gains from that. It will come to an end at some point, the timing of which is very uncertain at this point, given that this has been driven by largely very idiosyncratic global factors. But second to this is not just our debt situation hasn't improved just because of this. There is also important fiscal consolidation drive coming from the government at the moment. Yes, there are many risks at play, given, for example, I spoke to in the presentation, the extension of the fuel levy. However, and as it stands, we have seen this drive from government to really cut down spending. They've taken a hard stance against wage negotiations, etc. Those sort of items. They refuse to bail out for the bailouts for SOEs, etc. So we're really seeing this drive towards fiscal consolidation. Yes, it is at the early stages, and there are various risks at play, but we have seen it shift more towards that aspect. So we have got that backing, just the revenue windfalls. Nolan, not sure if you want to add more onto that.
No, I think that sums it up. I think the point is that, on the commodity prices, I'm not seeing anybody forecasting commodity prices coming down, certainly not with the global dynamic as it is, particularly actually energy prices, where South Africa and the fiscus is benefiting from coal prices being pushed higher as well. China is going to miss its growth target quite meaningfully this year, and the only way they get there next year is to stimulate the heck out of it. So it's reasonable to expect that commodity prices will continue to be a lucky position for South Africa for at least another year or two.
Is that how long you expect the current accounts to remain in surplus for?
So moving on to the second question, the current accounts, the terms of trade have actually been increasingly moving positive, driven primarily by coal prices versus oil prices. We certainly expect that the current status quo is likely to remain at least as long as the Russia war goes on, and probably beyond that. So, when does it stop? I don't know. But certainly I'm not seeing any signs of it stopping right now. And that probably means that, our crystal ball is reasonable out to a year and a half. So for the foreseeable future, I think we're in a positive current account environment, while commodities happen to be in our favor. What do sharp interest hikes mean for bonds, which was the other question we had? It's all in the price. I mean, basically, the Reserve Bank can hike interest rates by another 1.75%, put the repo rate at 6.5% over the next 12 months, and it's already priced in. So from that perspective, we don't see the Reserve Bank actions as being particularly negative for bonds. If anything, I think the propensity and the expectation is that the Reserve Bank isn't going to hike as extremely, and therefore we'll continue to see what we see every time where the Reserve Bank does actually hike, is they communicate that it's not going to be as drastic a hiking cycle as you're seeing in the US. We don't need it. And consequently, it actually becomes a bond supportive exercise. And over the last two MPC meetings, both times we walked out of there and yes, they hiked, but bonds also rallied and showed a gain.
Which actually blends nicely into the question from Eugene, which is, will the aggressive Fed and potential ECB rate hikes force the SARB to be more aggressive?
Yes, to a degree. The Fed and the ECB set the price of money globally, and we do think that the SARB is going to feel pressure from that, and it definitely is an input into how they think. That being said, we've said for a while that, if you look at the sort of gap between where the SA rates were and where the Fed was pre-COVID, and if you look at the gap today, that gap has widened out. Theoretically, it should actually have narrowed, partly because our inflation isn't as high as that in the US, and partly because our fundamentals are better. So it's kind of moving the wrong way. So we see more potential for that gap to narrow, and I think it has already narrowed this year as the Fed's been more aggressive. We see more scope for that. So in the short term, yes, the Fed's probably going to put some pressure on the SARB. But looking at our domestic economy, there is definitely capacity for that differential to narrow out again, back to where it was.
Okay. I've then got 3 questions I'm going to combine into one because I think they all cover the same sort of topic. So firstly, one asks, so yes, government is talking the talk, but given their history of not walking the talk, I guess your positive outlook is making a huge assumption that this time it will be different, ? Second question is, how should South Africans factor in political risks to SA prospects going forward, economically? For example, the risk of Cyril being pushed out of the ANC and sidelined. And then Charles asked, which I think is similar, the risk of a bad outcome at the ANC elective conference end of the year and the impacts of that.
Casey, do you want to run with this government?
I think I'll take I'll take a stab at that. So yes, it is difficult to see sort of, positive nature when considering the ANC. We have been let down and felt so much disappointment over the last 10 years or so. However, I believe it's not just a case of walking the walk or talking the talk as opposed to walking the walk. We are seeing now some actual policy reform coming to the play. I mentioned those various sort of policies around the middle of my presentation. And those aren't just wish lists or things the government is sort of talking about within the media. Those are actual policies that have been implemented and they are running at the moment. It's not just a change in tone. There are concrete actions being taken, both within the policy reform part and also within the sort of the political rhetoric in that as well. So it is a case of there are actual physical changes happening at the moment. It's not just for the sake of happy appearances. And I think the second question on the political front with regards to the risk or the sort of key man risk with Ramaphosa, at this point, I don't believe that there is a risk of him being sidelined out within the ANC. Of course, in the media, there has been a lot of noise this past week with the whole scandal emanating from the alleged, robbery on his farm. Of course, this is being used by various agents within the party to end sort of their own means. However, at this point, I believe that Ramaphosa has really consolidated his position with the ANC quite strongly. If we consider candidates who could take his place, there are no real viable candidates to replace him at this point. And the ANC, I don't believe, would take the risk of putting a least popular candidate through. They are, of course, taking a lot of pain in the polls at the moment with the drive of various other smaller fringe political parties, but they are eating into the voting base of the ANC. So if we consider I think the ANC is a collective whole at the moment. They themselves, the party, will not take the risk of pushing Ramaphosa out into the uncertainty that they have. So I believe that within the various elective conferences, which will accumulate in the December conference at the end of the year, there will be a lot of noise, a lot of media handlines. We have those proponents of the previous fiscal, state capture days, of course, taking large stabs at the president. However, at this point, I don't believe there's a risk that Ramaphosa will be sidelined as of now. There will be a lot of noise, and he's under a lot of pressure and pain at the moment, but he will see his way through it, I believe.
Great, thank you. And then I think probably the simplest, but probably the hardest question to answer, because it's so broad in its application, is what if you're wrong? And that's not pointing to the answer you've just given, but I guess in all that we've said. So the sort of what if you're wrong? What if our base case assumption is not right? Doesn't play out as we assuming? What then?
Investing is an imperfect science. We are wrong. There's no chance that anybody can sit and look at what's coming down the line and get it 100% correct. And there's a variance on returns as a result. If we are wrong, we're suggesting take exposure through the Flex Income Fund to R186 bonds that mature in 2026. If we're wrong, you're going to see, some pretty poor returns. It's going to be a bit of a tough environment for a while. However, those bonds mature in 2026 and you get your money back, and you get your money back with interest. And that's the beauty of bonds, is we can be wrong, but the actual design of the financial investment is such that if we're wrong, by 2026, it works itself out anyway. You get your money back, you get your 8.5% per annum interest income, and that's probably not a bad outcome. So if we're right, you earn your interest income a little bit faster, you see a bit more capital gains, you probably capitalize on that and move into equities. And if we're wrong, you kind of, sit around sort of, it's a bit of a grumpy time in the markets. I'm particularly grumpy, but when the bonds mature, your cash is actually still in the bank account.
Thank you. Then switching over to the US, Godfrey asks, inflation is not the only driver of long bonds in the US. Quantitative tightening is also a factor. To what degree do you think quantitative tightening is priced into, say, the 10-year US bond? If quantitative tightening is not fully priced in, do you think there's actually an upside risk to yields and the pain in bond markets is not over yet?
Okay, Casey, I'm going to take that if you're good with it. So quantitative easing basically works where the US Fed prints money. And there's a point in time where they say, we've got to take all this money we printed and we've got to destroy it. And that's quantitative tightening. So they take money out the system. As they take money out the system, there's less money going around. There's a bit of sort of squeeze for cash. At the moment, what you've got is the US reverse repo market is sitting on about $4.5 trillion of cash. What that basically means is that in the US, if a bank is sitting with cash it doesn't need because no one's borrowing it, no one's using it, the cash is just idle, they go and park it at the Fed on the reverse repo. So the Fed's sitting with idle cash in the US economy of about $4.5 trillion. The Fed has also said we are going to quantitatively tighten, i.e. we are going to destroy cash of about $4.5 trillion. So the two actually kind of neatly match each other out. And in a perfect world, what you're going to see is all these cash reserves sort of disappear because it's idle cash at the Fed that isn't in the economy, kind of gets taken out of the economy. Your man in the street doesn't feel it. So that's the sort of perfect scenario. Now, it never quite works that way. So there will be sort of pockets of tightening here and there. Second point is that a lot of the quantitative easing money this time around actually found its way into the equity markets. We saw some interesting and lofty equity valuations. A lot of the money has actually come out of the equity markets and moved onto the Fed's balance sheet from that perspective. So, I would argue that economically, a lot of this has already sort of taken place. And that, looking forward, things should actually match each other out quite neatly. We're already quantitative tightening. The Fed's destroying money this month. It's the first month that they're doing that. And we do think, that it's been very well communicated to the market and therefore is actually in the price. Though from time to time, we're just going to see bouts of uncertainty. I think the environment we're in is going to remain volatile. But by and large, the market has adjusted to quantitative tightening.
Thank you. I've then got a ream of questions around exchange rates and the impacts thereof. So I'm going to chuck them all at you. Firstly, view on asset swap spread, especially around the R186. That's the first question. Second question is, how much does your SA CPR view depend on the US dollar exchange rates? Third one, will exchange rates have an effect on the returns offered by bonds? And then the last one, are you expecting something crazy to happen to the rand's value, whether one should invest locally in bonds or internationally? So they aren't the same question, but kind of all deals with the same topic. So,
am I expecting something crazy to happen to the rand? Yes. I'm like the only guy out there, and we have been for a while, saying that, the rand probably has a greater probability of strengthening rather than weakening. We put that view out there in January when the rand was at 16. We've been somewhat right over time. Continue to hold that view, actually. And we hold that view because, what we saw in terms of sequence of events was the market massively pricing in quantitative tightening and rate hikes in the US. And that strengthened the dollar, which looked like a weak rand for much of this year. We're now getting to the point where the action is actually going to take place outside the US, and it's probably going to be taking place a lot more in Europe, where the Europeans are going to start talking more and more rate hikes. We saw that yesterday. They're going to start talking quantitative tightening. Well, that's kind of happening anyway. And as a result, what that will now start to do is kind of strengthen the euro again, which kind of looks like dollar weakness. Typically dollar weakness looks like rand strength. So we do think that the rand probably has scope to strengthen from here on out. It's going to be a volatile strengthening. It's going to bounce around, but a positive current account surplus coupled with a macro environment where Europe is tightening equals the rand is probably more likely to strengthen than it is to weaken. What are we pricing in? Why does the rand matter for inflation? It matters because the rand drives the rand plus oil price equals price of petrol. We've all seen the oil price shock come through the numbers. If the rand strengthens, that's great. If the rand actually weakens and unexpectedly, which it will do in a volatile environment, there are going to be some tough months at the pumps. And from time to time, we do think that that's going to sort of spike our inflation forecasts, and it'll wobble bonds around a bit. I come back to the fact that within 4 years, your bond's going to mature anyway, and therefore it's going to create a bit of noise. If you're comfortable to look through it and say, look, I just need a safe, reasonable investment for now, this is the place to be.
And the other one, how does your CPI view depend on the US dollar exchange rate?
Sorry, I tried to cover that. So the CPI view is a function of petrol price, which is a function of oil plus rand dollar. So a stronger rand definitely helps CPI. We're not anticipating a massive sort of blowout in the currency. That will definitely hurt CPI, and it is probably a big risk to our view.
Brilliant. We are out of time, so we've got loads of questions. I'm afraid I'm not going to be able to get to all of them. I'm just going to pick another one, the last one at random, and then we'll end the session. What's your view on inflation linkers? Would you be selling these in favor of nominals at the moment?
No, I would not be selling. I think that at the moment, inflation linkers and nominals are probably much for muchness. Inflation linkers were definitely the trade over the last year. Truthfully, I think Anchor probably missed out a bit on that. It's not a perfect science. But yeah, inflation linkers do have their merits at the moment. As the cycle progresses, when we start to see meaningful evidence of inflation coming down, Q3, I think that's the point in time where I'd actually sell the inflation linker. But for now, I think if you own inflation linkers, I'm kind of neutral on them, between them and nominals, and I'd continue to hold them.
Brilliant. Thank you so much, Nolan and Casey, for presenting today and sharing your views and insights. And thank you so much to everybody who took the time out to spend time with us today. I'm sorry we couldn't get to all your questions, but hopefully what we shared with you is both insightful, informative, and of value. So have a brilliant Friday, and see you at the next one.
Thank you, everybody.